Now, welcome to the Insight Empire. This is your number one source of trading insight, and I am Blue Ball Forex. Now, today we're going to be talking about one of the 7 institutional reference points. And when we talk about institutional reference points, basically this means we are talking about ICT smart money trading. This is where we trade based on specific points of interest that are referred to as the institutional reference points. The idea behind trading ICT is that we have two market participants. We have the smart money, and then we have the retail traders. Now, the smart money are elites, are the people like investment banks, are people like hedge funds, high frequency traders and stuff. Now, these are people who have access to significant capital and also experience in the matters of the forex market. And these are the people who we want to leverage on and enter the market only when they are entering, and get out of the market at a time when they are also exiting the market. We don't want to compete with the smart money. We don't want to buy when they are selling. We don't want to sell when they are buying. Our aim is to exactly follow their footprints and be able to see whether we can harness something from it, because as a retail traders, most of the time you get disadvantage because one, you have access to information which is not privileged as compared to them, and secondly, you do not have the significant capital that they are running. For example, trading with $2,000, $3,000, $5,000, sometimes even some of us trading with $50, $100, you discover that you are already disadvantaged because these people have a huge capital and then they are targeting some small realistic returns. All right. For example, if you have $1,000 and then you target 10% per month, that means probably you are targeting $100. But for them, they will have, let's say, $50 billion, and then they are targeting that the same 10% even per year, and you discover that they are already beating you, not because your strategy is weak, but because of the projections that you are having, your level of experience, and also the available machinery that is available for you to be able to leverage on. Now, today we are talking about fair value gap. And what is basically a fair value gap? Well, a fair value gap is one of the institutional reference point, and basically what a fair value gap means, this is a point of interest which is left in between a 3 candlestick price action, with a candlestick at the middle not completely being interjected by the other 2 candlesticks, and that is exactly what I'm going to explain now. Hand over to our chart here, and we have a very amazing price action. This is XAU USD, which basically means gold market, and as you can see, we have a series of fair value gaps forming. To be able to know where these particular fair value gaps are, there is an indicator that can be able to help you to see them. It's called fair value gap by Lux Algo. You just go to indicators tab, and then it will put for you all the available fair value gaps for you to be leveraged on. Now, 2 things that I want you to discover is that anytime you're trading, the basic business principle of any business is to buy low and to sell high. That is the basic business principle. Even if you're selling clothes, you are in the car business, whatever business you are in, you want to buy at the lowest possible value and sell at the highest possible value, because leveraging in between what you bought and what you are selling at, that is where the profit is. The same case is what we do in the forex market. Now, for example, if I have to, for example, to look at this particular market, this is a range. This is the lowest point that this particular market reached. I want you to see this. And this is the highest point this particular market reached. All right. Now, I want to know which part is the discount part and which part is the premium part. Okay, because that is basically what we have. So I want to put my fib tool, and then I will put it from the highest to the lowest point that particular market reached. And then this lower part is called the discount zone. The 50% is called the equilibrium. All right. This is how to successfully trade this particular institutional reference points you are calling fair value gaps. All right. And then the third one is basically what we call the premium. Amazing. Now, this is it. At any range that you draw, this is basically what we call a market range. This is the lowest point of the market, and this is the highest point of the market. So at any point of life, you do not want to buy at the premium, because basically premium means things are expensive. So the price is at its most expensive peak. And when you buy things when they are expensive and sell when they are cheap, it means you have made a loss. And when you buy things when they are cheap and sell when they are expensive, it means you make a profit. Discounted basically means cheap. All right, if this particular sweater I sell it with a discount, let's say of 40%, if it goes for $50, and then I said, for example, with 40% discount, it means I'm selling probably with $20 or $22 or something. So this means by that design, I will be selling it cheaply. Okay, and so at the discount zone, or at any point that you want to interact with the buyers, you want to make sure that they are at the discount zone. At the equilibrium, you don't want to engage because the market has 50% of moving to either of the direction. At the premium side, you want to strictly look for only sell opportunities, and this is an infinity glitch to success in the forex market. Actually, some of you are learning too much, bro. Just learn how to buy low and sell high. That is one of the edges that not so many people leverage on, and I can assure you that there is some money hidden there. Now, let's dive into the charts. Now, when you look at this particular point, you will discover that we have fair value gaps, and these green noted things are the fair value gap. Let me explain how fair value gaps are formed. Okay, now you want to see a 3 candlestick price action. Let me draw some price actions here. That's a price action and another price action over here. So assume these are bullish candlesticks. Please forgive my handwriting. I'm not so good in symmetry. Assume they have wicks. Assume the candlesticks have wicks. And then I'm going to draw 3 price actions. This will enable you to know when to trade these particular fair value gaps. All right. This one is bullish. Very nice. And then we're gonna draw another one at this particular point. Okay. Please note that the color of the candlestick does not matter as such here. Okay. Now this one I'm going to add the 4th candlestick like that, and probably also have it as a wick. Now, this is it. When you look at this particular price action, and then this is the last price action that I'm going to make over here. This price action has wicks. So candlesticks printing around as wicks. They as wicks like that. Now these ones we completely interject. Now let's study these 3 candlestick price actions. You discover 3 things. Okay, we forgot some wicks here, probably just for quality assurance. Amazing. There is some bogus art here, but it's not a concern as such. Now, I want you to look at those 3 price actions printing, all right? When you look at in between this candlestick and this other candlesticks, this one can be a bearish candlestick. I've said the color of the candlestick is not an issue of concern. What you want to see is this. In between these particular 3 candlesticks, assume this is candlestick 1. Here we have candlestick 2. And then here we have candlestick 3. Amazing. Now, between candlestick 1 and candlestick 3, there is the candlestick 2 at the middle. Now, the candlestick 2 at the middle, when you draw a solid rectangle at that particular point, you can see there is a gap. You can see there is a gap, and make this one black. You can see there is a gap. That particular gap is basically what we call fair value gap. That particular gap is basically what we call the fair value gap. This particular gap in the middle is basically your fair value gap. Now, this is how it works. When you look at the other candlestick price action, this candlestick price action, these particular 3 candlesticks are completely interjecting each other. So if you try to put the same rectangle, even if you clone this same rectangle, there is something you understanding that this particular rectangle is not giving you the same gap here. When you put it here, it's completely blocking the 3 candlesticks. But when you look here, you can be able to see through this candlestick and the other one. So this means that there is a gap in between. The same gap is also available here. Now here is the trick. Now, when we have a candlestick which is adjusted to the 3 candlestick price action, so many people will assume that this is where the fair value gap is, and this is where they miss it big time. So this particular price action, our fair value gap starts from that particular candlestick going all the way up. Now this gap is our point of interest, and how we want to trade this is we want to make sure that the market comes back to revisit this particular point of interest. Now that particular FVG is a point of interest. So we don't want to buy after immediately the market has just left that particular gap. We want to wait for the market to come and fill this particular gap. And as it is coming to that particular gap, that is where we want to see our entries and pick them. So this is the traditional way of basically trading any particular fair value gap. Now let's go back to our chart. As you can see here, we are having these particular gaps being filled. So we have a fair value gap, as we have just highlighted. Then we have another fair value gap, as it has been highlighted. Then we have another fair value gap, which has been highlighted. All right. Now, in this particular case, the most discounted, because our idea, we want to buy from the most discounted zone and sell from the most premium zone. All right. Now, when you look at, for example, this particular range over here, all right, let's pick this original range where the market moved from this point being the lowest point and it went all the way up. All right. So this is where we have our equilibrium. This is where we have our discount zone. I want you to pay attention to what happened here. You are supposed to trade from the most discounted array or from the most premium array. And I'm going to be explaining this. I know there is, at some point, especially for ICT traders who know what order blocks are. If you have not understood what order blocks are, I made a video you are going to see is still in this same YouTube channel explaining how order blocks work. Now, sometimes you will find that we have an order block and a fair value gap in the same position, and you do not know what to enter from. Now, I want you to pay attention. At the discount zone, I'm going to be making a video explaining something called PD array. PD array basically means premium and the discount arrangement of all those arrays. Basically, the order block, fair value gap, breaker block, mitigation block. The other one we call a rejection block. We have a liquidity voids, and we have odd highs and odd lows. So those are the 7 institutional reference points. Basically, we call them arrays in ICT. So now the PD array means the premium and the discount arrangement of these arrays in their order of preference, okay? Where you find an order block and a fair value gap at the same zone. Which one are you likely to trade from? Are you supposed to trade from the order block or from the fair value gap? Now, this is it. At the discount zone, please, I want you to note, at the discount zone, a fair value gap is more powerful than the order block. All right? At the discount zone, the fair value gap is more powerful than the order block. And at the premium zone, the order block is more powerful than the fair value gap. Means the market is at the premium side. We are probably looking for order blocks more than we are looking for fair value gaps. But when the market is already in the discount zone, we will be probably looking to trade from the fair value gaps more than from the order block. And that is exactly why you look at this particular price action that printed over here. This is the most premium. This is the most discounted array which printed at this particular point. And as you can see, the market came back to that particular point. All right. So the market printed to us this kind of a price action, went away from the zone, came back, and boom, it went. Why? Because this is the most premium. This is the most discounted. The basic business principle is to buy at the lowest price and sell at the highest price. Now, so since we are looking for a reason to buy basically at the lowest point, it means now this will be the most valid array for you to be able to trade from. Now, these are basically what we call the fair value gap. And how do you trade a fair value gap? You want to wait for the market to come to the fair value gap. You should basically have your stop loss. If you are going for a long position, just below this particular fair value gap, and probably you target a 1:2, 1:3, whatever risk to reward ratio that you have, and then you're gonna see how the market played out to your price action. This is basically how we trade based on these particular institutional reference points. And one of the advantage of ICT trading is because the point of interest most of the time becomes this particular institutional reference point, unless you are trading based on the turtle soup, which is a liquidity-based trading strategy. But so long as your trading setup is informed by the arrays, you only have a strict place to enter from, and then your stop loss just below that particular zone. So at any point the market violates that particular zone, anything you continue holding, basically that's a gamble and it's not a good trading habit. We're gonna talk more and more. This is Blue Bull Forex, and see you of course in the next video. Remember to subscribe, and also we have attached a link to our free Telegram group, which you can be able to join and leverage on our skill set any day, anytime. This is the Blue Bull Forex.